Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. Okay, so you're looking for a cheap stock. You're looking for a high quality company. You'd like an above average dividend yield, and you want to own something that's going to be relatively safe. There's a good chance that Bank of America showed up on your screen and you're trying to decide if it's a bank that you want to invest in or not. I'm Jason Hall. This is The Smattering. There's three things with Bank of America I want to talk about. Investors should really consider and understand before they buy. Before I get to those, though, I just want to thank our sponsor, The Motley Fool. If you're looking for some more great stock ideas, go to our link. You see it right over my head, fool.com/the smattering. Motley Fool is going to give you its 10 best stocks to buy right now. Check that out. I think you'll be glad you did. Okay, back to Bank of America. So first of all, what are the things that we want to talk about to begin with? I want to talk about its return metrics. And with banks, there's two important numbers. There's ROE, which is return on equity, and then there's ROA, which is return on assets. So what does that mean? So we'll start with ROA. That's all of the assets. So you think about the way banks work. There's super leverage. For every 10 bucks that a bank has on its balance sheet that it lends out, usually the way it works is $1 of that is investor equity. Again, the equity that was funded into the business and that represents the ownership. And the other $9 is usually deposits or other sources of capital that it may use. So again, it's about 9-to-1, the leverage that these businesses use. So on ROA, the benchmark is 10%. You want to see 10% or higher return on assets. And the good news, Bank of America is delivering that. Their ROA numbers are actually better this year, both the first and second quarter, than they were year over year. Then we look at return on equity. The benchmark is about 1%. And Bank of America's return on equity came in at almost exactly 1%, slightly below it. So not great, but an improvement from last year. So that's a positive. Okay. So with that said, I want to say investors should be cautious looking forward, thinking about Bank of America's returns going forward. And the reason for that is, like a lot of banks, Bank of America has a ton of low yield loans, all those fixed rate mortgages from everybody that refinanced in 2020 and 2021, 3% or less, and they're fixed for 15 or 30 years. The challenge for any bank right now that has a lot of those loans on its book is managing its cost of capital. So Bank of America has this fortress that's been just such a wonderful advantage for so many years of ultra low cost deposits. I'm concerned we might start seeing some cracks in that armor as depositors start shopping for higher yield. If you can get 3.5, even 4% yield in a high yield savings account or a CD, you might want to start pulling some of your money out of Bank of America that's still not giving its depositors very much in the way of yield at all. If we start to see that happen, it's going to be really challenging for Bank of America to generate decent returns because its cost of capital is going to go up as it seeks alternative funding or is forced to start raising interest rates that it pays to depositors on their savings, checking, and CDs. So be mindful of that thing, number one. Number two, and I'm going to share this on the screen here, I want to talk a little bit about valuation because I think there's some things that are important for investors to keep in mind. So first thing you can see on the top here, we have price to book value. Why does this metric matter? Because this says what is the bank worth versus the book value of the assets that it holds. And that could include like the real estate, but mainly it's going to be things like the loans and the cash that are sitting on its book, those financial assets. That's the vast majority of Bank of America's value. So at this point, you look at it and you're like, well, 99% book value, that's trading for a discount to book value. That looks pretty cheap. And again, you look over the past decade, and for the most part, that's about as cheap as it's been really for at least the past 6 or 7 years, when this was still a troubled bank that was still trying to turn around from the financial crisis. So you look at that and say, hey, that looks pretty cheap. Here's the caution. The caution is that this price to book value is not based on mark to market accounting. What does that mean, you might be wondering? Think about all those 30-year mortgages at 3% or less interest rates. Those mortgages, if Bank of America needed to sell some of those to raise capital, are not worth what Bank of America acquired them for or what it issued them for when it funded those loans. And because interest rates have moved up so much, if they needed to sell those, they would have to discount a ton of them, 25% or more, simply to sell them because of where interest rates are today. So that price to book value can be a little bit misleading in the case the Bank of America needed to sell those assets to raise cash. Now, ideally, it's going to be able to hold them on its books, and they're going to be fully amortized, and it's going to get all of its money back, and it won't have to lose any money on any of them, or just a very small amount of them, right? So, but again, just think about that with valuation, because there could be a little bit of a value trap with B of A and some of these other large banks in that regards. Now, let's talk about price to earnings, the PE ratio. You might see that and say, wow, 9 times? That's crazy cheap. And yes, it's pretty cheap. I mean, the last time we really saw Bank of America at these levels for a protracted period was during the crash, during the coronavirus first few weeks and months of the pandemic, when everything was down pretty significantly. But all that to say, it might look a lot cheaper than you think it is, because the market PE of the market is much, much higher. Banks tend to trade for lower PE ratios because they are so leveraged. So that's a really important thing to keep in mind too. Now, last thing I want to talk about is that dividend yield. So again, 22 cents a share was the last dividend that it paid. It just announced a 24-cent dividend. So we know that dividend is about to go higher. We also can see B of A's been doing a pretty good job the past decade since it re-implemented the dividend as soon as it was able to after the financial crisis, growing it every year or two, right? And growing it at a pretty good rate. So you put all of those things together, those 3 things, talking about where its returns are, some potential threats to those returns. You talk about its book value and its price to earnings multiples, and maybe a little bit maybe not as cheap as you might think it is. And again, looking at the dividend, and you put it all together, and Bank of America looks pretty strong and it looks pretty cheap. It's not ultra cheap, but I think it's a reasonable value. But investors need to be aware there are potential risks to banks going forward, particularly if interest rates stay high. As much as it can be good for banks on new loans that they issued, for banks like B of A that have a lot of legacy, very low yielding mortgages and other loans on their books that are fixed rates, there's going to be some kind of lag from that kind of thing that can actually hurt their returns in this environment. So just be aware of all of those things and invest accordingly.